I'm joined by CAS's Dr. Dirk Nitzsche to discuss long-term savings using mutual funds. A recent report by the Policy Exchange found that most of us here in the UK don't save enough for our retirement. So Dirk, first of all, what are the implications of this report?
Well, on the one side, that's good news because if people go out and spend money, that helps for economic growth and we're going to get out of recession. On the other side, that's bad news because we all live longer and we won't have enough money for our retirement. So what this report basically highlights is we need to save more for our retirement.
So you suggest investing in mutual funds?
Yes, I think for the long term, everyone should have some exposure to equity mutual funds. There's been a lot of evidence which suggests that in the long run, equities outperformed other asset classes even after inflation. It helps us to reduce the risk via diversification. And if you look at the US, for instance, more than 50% of the households have exposure to mutual funds.
But I understand there are thousands of different mutual funds. How do we choose?
Indeed, there are thousands of mutual funds investors can choose from. The vast majority are actively managed. That means a fund manager picks the stocks, decides which securities the company should invest in, and then about 20% of the industry is passively managed. They're much cheaper because they basically just follow one of those stock market indices.
So you suggest passive rather than active funds. Why is that?
Yes, our recommendation is that retail investors should go passive. Active mutual funds are about 4 times more expensive when it comes to management fees, and there is no evidence that actively managed mutual funds outperform passive ones.
But some of these funds show very high returns. Surely I can pick one of those.
Well, that's true. What you're going to raise here is 2 interesting points. On the one side, we've got thousands of funds which suggest that some of the funds might show a high performance by chance alone. That means they're basically lucky. And on the other side, there's also a lot of evidence which suggests that there's no persistence in mutual fund performance. Certainly not amongst those well-performing funds. So a fund which has done well in the past will most likely not do well in the future. So picking funds which are high up in the league tables is a waste of time.
So we shouldn't pay any attention to those league tables?
That's right. Our research has shown that retail investors in particular would be much better off if they're going to invest passively. And maybe you might want to look at the management fees so that you invest in a passive fund with low management fees. For retail investors, it is impossible to identify the star funds, the very few star funds. And our research has shown that the vast majority of mutual fund performance can be explained by luck.
Dirk, thank you for joining us.
My pleasure.